Welcome everybody, and thanks for joining. And today I'm going to talk to you about ultimate retirement plan. And before I jump into that, just very quickly a little bit about myself. And before I do that, again, just a quick disclaimer here that Sense Financial Services is not a fiduciary. We do not provide legal, tax, or investment, or accounting, or any other professional advice. I'm an investor myself. I deal with various issues on a daily basis. But if you do need professional advice, please talk to an expert. My expertise is in self-directed retirement accounts, and that's what I'm going to be talking about today. But just very briefly about my background and how Sense Financial come to exist. I was working with, actually started in real estate investing back in 2000 and went full-time in about 2005 and was working with a local real estate investment firm, helping clients grow their portfolios, real estate portfolios, and just over the years, I've seen that people had similar feedback that their retirement accounts were not doing well while their real estate portfolios were growing. And I knew it was possible to use retirement accounts to invest in real estate, and I basically started pulling all the information together, meeting with the experts in the field. And also my background before I went into real estate was in financial planning and retirement planning, so it was a familiar subject to me. And I started Sense Financial in 2010 just to help a few of my clients, but pretty soon referrals started coming in, and that's what all that we are doing right now. We are basically helping folks unlock their retirement accounts and use those to invest in alternative investments. And basically that's our mission. We helping our clients obtain control and protect their retirement accounts. And basically there are two ways that you can do that. You can do it with self-directed IRA, and you can do it with self-directed solo 401k. And the second option, second vehicle, gives you a checkbook control, and that's the basically another name for ultimate retirement plan. The solo 401k is. Now, let's take a look at self-directed IRA, what it is. Basically, it is a tax-deferred trust account that is held with the IRS-approved custodian, and it allows you to use your retirement funds to invest in non-traditional assets. And the reason that most of the people are not aware of their existence, because your basically major financial companies like Fidelity and Chase and so forth, they want to keep you invested in the stock market, and your financial advisor or a stockbroker want to keep you invested in that because that's how they make money. But they've been around for quite some time, since 1974, and they are designed to benefit people like you and I to save money for the retirement under Internal Revenue Code Section 408. Now, just a quick comparison here between a conventional retirement account like most of you have out there and a self-directed. If you have a conventional retirement account, your investment choices are limited. You're limited to stocks, bonds, and mutual funds. And even so that sometimes I hear these arguments when people say, well, you know what, I do have a retirement account and I am diversified because I invest in this mutual fund which is broken down into investments into 100 different companies. And that might be true. You might be diversified, but you're only diversified within one asset class, equities, and you have no underlying security. The paper assets can be gone. You know, it's potentially you can lose its value overnight. You know, company can go down and you can lose everything, and it's very common. I know many people who lost 50% of the balance in their retirement portfolios because they were just invested in equities. And here is a quick example for you of when you have a 401k at work or at your employer, just a typical example of the investment options that are available. As you can see, just a handful of choices, and all of them are basically just some mutual funds. That's pretty much all you can do when it comes to your investment choices. If you have an IRA, you have more options because typically with an IRA you have access to more mutual funds, but again, it's just that one asset class. Now, when it comes to self-directed retirement account, when you switch from a conventional IRA into self-directed, your investment options are virtually limitless. You can use your retirement account to invest in real estate. You can invest it in tax liens and tax deeds. You can do real estate options. You can actually become a bank and invest in mortgage notes and trust deeds and do hard money loans out of your retirement account. You can invest in businesses and partnerships. You can even buy real estate out of U.S. I do have clients who one investing in South America, another one investing in Canada in real estate. I do have a couple of clients who actually invest in India. So you can do that. You can invest in private businesses that are not publicly traded, and you won't be able to invest otherwise into those businesses, but you can with a self-directed retirement account. And here is another thing. If you wanted to kind of stay diversified, and if you wanted to keep portion of your portfolio in just a conventional stocks and mutual funds, you can do that with self-directed IRA. One misconception that sometimes people believe is that if you set up a self-directed IRA, you can only invest in real estate. No, you can pretty much invest in anything that is allowed by law. And after having a retirement account, you may feel like this. By the way, this the credit for this cartoon goes to my daughter, and here it says here that I finally decided to put something aside for our retirement, our plans to retire. So if you feel that way looking at your 401k or an IRA statement, just basically reflecting the stock market and going up and down, and over the long term overall value of your account going down, then this might be the time to change for you. It might be a time for you to look at alternative investment options. And self-directed IRA and 401k will allow you to do that. Now, here is an example of one of our clients. Jason contacted us a couple of years ago. I actually personally spoke with him, and he had a couple of different accounts, an IRA and 401k. He had about $135,000 combined value, and his retirement accounts were losing money in the stock market. And he was concerned about the state of the economy, state of our government debt that just keep increasing, and he was looking for a way out. So he just basically liquidated all of his holdings. He put everything into cash because he did not want to lose any more of his money. So he contacted Sense Financial. He was self-employed, so we created self-directed solo 401k plan for him, and he was able to diversify his retirement dollars into different assets. He actually purchased a property with his retirement account, so his 401k owns this rental house right now. So all of the rental income that is collected every single month now going back into his retirement account. Then he took portion of the money and he invested into his brother's manufacturing business with great potential. And then he took the rest of the money and he actually purchased a note. He was able to fund somebody else's investment, and he actually used his retirement account as a bank where he's the lender, somebody else owns the property, and he collects monthly interest payments on that note. Combined, he's getting about $1,000 a month in a cash flow. As you can see, just compare what he had before versus what he has now. I'm sure you will agree with me that he is much better diversified. He has much more control over his investments right now. When you invest in the stock market and buying stocks of certain companies, I'm sure you will agree with me that you and I, we have very little to no control over the performance of that investment, because we have no control over the decisions that the management of that company makes and how they're gonna, or where that company is headed. But when you invest in real asset like real estate, you have the control where you're going to buy that property. You have the control over what kind of improvements you're going to do to that property. You have the control who's going to live in that, who you're going to rent it to, and you have the control when you can sell it. You can watch the timing. So you have a lot more control when you invest in something. And when it comes to investing, folks, you should be investing into something that you understand. And real estate is something that each one of us live in. So we can probably relate to that and can control that much better. So now let's jump into solo 401k, and throughout this presentation I'm going to compare and just kind of compare the IRA versus 401k and compare the two. But solo 401k is not a new type of plan. It's basically, just as the name implies, solo is designed for self-employed individuals or small business owners, and the 401k comes from Internal Revenue Code section 401 subsection K, and it's not a new type of plan. It's just basically your basic 401k that many of you had or have with your current employers, but it's designed just to cover a business owner and his or her spouse. And increased interest in these plans became after some changes in the tax law in 2002, and those changes made many benefits available, and we'll go over those. But there is a 2 qualification criteria for a solo 401k. To be eligible, you need to have some kind of self-employment activity or self-employment income, and it can be in any type, shape, or form. You can be a doctor, you can be an attorney, property manager, even managing your own properties. And the list just goes on and on and on. So if you receive 1099 income, or if you have income that you report on Schedule C, then that means that you're self-employed, you have a small business. You might be even employed full-time, working for a company as a full-time employee, but as long as you have that side business or generate that side income that goes on Schedule C, you qualify. And then number 2 is the absence of full-time employees. With the solo 401k, because again it's designed for just a single owner and their spouse, you cannot have any employees that work full-time. And IRS definition of that is 1,000 hours or more a year, which comes down to about 20 hours a week. So really the only thing that could disqualify you from setting up a solo 401k, because anyone can have a self-employment. Really, it's easy to create. So the only thing that will disqualify you is if you have a business and you have full-time employees in that business. Then this solo 401k plan might not be for you in that case. But absence of full-time employees is, as I mentioned, less than 1,000 hours. And if you have a company and you lease employees, basically they might be working for an agency and you contract with the agency, but if they come, if they actually work at your location and they clock in and clock out, they're not directly your employees, but they're still considered your employees for the purposes of the 401k plan. So they will have to be included then. But excluded employees are those who are under 21 years of age. So if you have somebody under 21 and they work full-time, they can be legally excluded. Those who work less than 1,000 hours, and union employees and non-resident alien employees can be legally excluded from participating in the plan. Otherwise, you cannot have any full-time employees. Now let's talk about the benefits of the solo 401k, which is the most exciting part, because every time I talk about this, I get excited because those benefits are just so awesome. Number 1, let's talk about the contribution limits. Now, as you guys probably know, the limit on contribution with an IRA is $5,500. But with solo 401k, the contribution limit is significantly higher. And we actually, right now at the end of the year, and people are looking for ways how they can reduce taxes. I just did another webinar yesterday, and I had a tax expert, and he agreed that solo 401k is one of the best vehicles to defer taxes, to minimize your tax liability, because being a business owner, you have the opportunity to contribute both. You're actually wearing 2 hats. one half of an employee and one half of an employer. So you can contribute to a 401k plan as an employee, and that's it's called the salary deferral. And currently for 2013, that's up to $17,500 per year. Now, if you're over 50 years of age, you can take advantage of the catch-up contribution, which is additional $5,500, making it total $23,000 of salary deferral. That can be up to 100% of your self-employed earnings. So let's suppose that you have a full-time job and you have a side business and you make $20,000 in your side business. Well, guess what? You can put $17,500 out of that. $20,000 can go into a solo 401k. So most of that income can be sheltered. And this, the salary deferral can go into a pre-tax a portion of the 401k, or it can go actually into after tax. You can choose to pay taxes on it now and then put that into a Roth component. Next way to contribute is a profit sharing. So being a business owner, the business can also contribute into your 401k, and that's up to 25% of your compensation. And if you're a sole proprietor or single member LLC, that percentage is 20. And the profit sharing contributions made with the after-tax dollars, and the limit on both of them. So if you combine the two, it's up to $52,000 per year. And if you're over 50 years of age, again, you can take advantage of the catch-up, and that limit now is $57,500. So think about the potential of tax savings. If you're a small business husband and wife, and then you can potentially shelter over $100,000 of your income. I mean, that can be huge. If you're making $200,000 and you have to pay taxes on $200,000, guess what your tax bill is going to be. And now compare that if you're able to shelter about half of that into a retirement plan. Guess how much you're going to be saving. That's going to be huge. So folks, I do, if you're in that situation, I do encourage you to talk to your accountant and see the effect of that. Now, next feature is the loan feature, and Solo 401k has a loan feature allowing you to take up to 50% or $50,000 of your account value, whichever is less. You can access those funds before you retire. Now, think about this. If you have an IRA right now, you can't take a penny from that until you retire. And if you do that, which you can, but it's going to come with the consequences, you're going to be penalized on the state and federal level, plus you're going to be taxed on the state and federal level. But Solo 401k loan allows you to take a loan out for up to 5 years for any reason. And if you use that to purchase a primary residence, the loan can be actually spread out over 15 years. So that's huge. The payments on the loan must be made back to the plan either on monthly or quarterly basis. The interest rate is very low. It's set at prime plus 1%. Currently, that's 4.25%. The loan can be used for any reason whatsoever. You have access to up to $50,000 in your retirement account without taxes and penalties. And you can actually utilize this to invest in a transaction that otherwise will be prohibited transaction, because there are certain things that you're not allowed to do with your 401k. We'll talk about this, but you can do it with by taking a loan out. So by doing this, you're actually creating your own bank that will never tune you down. You are the one who's going to be approving that loan. And unfortunately, that feature is not available with self-directed IRA. Now let's talk about Roth contributions. Solo 401k allows you to make Roth contributions basically after taxes, and there is no income restrictions compared to Roth IRA. If you're making over certain limit in salary, you're not allowed to actually contribute into Roth. That's not applicable with Roth 401k. And the limit on that is $17,500 plus the catch-up up to $23,000 if you're over 50. Compare that with the Roth IRA, which is only $6,500. So when you make investments with Roth IRA, all of the income and all of the gains are completely tax-free. Now, before you can take out distribution from a Roth 401k, the account must be open for at least 5 years, and the distributions must be made after age 59 and a half. But your contributions, actually, the money that you put in can be taken out even before retirement because you already been taxed on that. Now, you can also do a Roth conversion, and you can convert a portion of your money that is in a pre-tax account into Roth. You will pay taxes on that conversion amount right now, but then you can invest tax-free, which is, again, you know, how many tax-free investment vehicles do you know? I think Roth IRA is the only one. Now, next benefit that it's very cost effective, and it gives you checkbook control. You can actually open up a bank account after the plan is established at any local bank or a credit union, or you can use even a brokerage houses like Fidelity or Schwab. There is no custodian that is required with the 401k, and that means that you can eliminate custodian fees forever. Any transaction fees that come with the custodian, you eliminate the red tape and all of the delays that come with the custodian. You serve as a trustee of your own 401k plan. That means that you're in control and you can act immediately on the opportunity that comes. Again, if you compare that with a self-directed IRA, if you wanted to make the investment, you have to submit certain paperwork, submit it to the custodian, and wait for them to execute that transaction on behalf of your IRA. Here, you do that. You act. There is no one in between you and your retirement funds. They're very easy to operate. There is no annual filing requirements unless you have more than $250,000 in your plan. And in that case, you have to file short form 5500 easy, which is, again, just 2 pages. It's very easy to file. You have to report the plan balance in the beginning of the year and then at the end of the year, and then you also have to provide or report any contributions that you made in that year into the plan. So again, very simple to operate and gives you a lot of control. Another benefit that it is actually exempt from the unrelated debt finance income tax, and the UDFI is a type of UBIT, which is unrelated business income tax, and it is assessed on any properties that is leveraged inside of an IRA. So if you have an IRA and you buy property and use leverage, you put down payment and you finance portion of the purchase price. If you use an IRA, you're going to be taxed on the portion of the income. But solo 401k plan is exempt from this rule. It's exempt from unrelated debt finance income tax on leveraged real estate. So again, it's just another reason to do that and to buy real estate with leverage. Another benefit is that it allows you to combine multiple accounts. Pretty much any type of retirement accounts can be pulled into the solo 401k with one exception, and that exception is Roth IRA. So if you do have a Roth IRA, unfortunately IRS does not allow you to convert that into a solo 401k, but any other accounts can be moved in. Now if you have accounts with the like employer-sponsored accounts such as 401k or 457, those accounts, if they're with the current employer, most likely the employer will not allow you to move them out. But if they're with the previous employer, or if the current employer allows you to what's called insurance distribution, then those accounts can be moved out and rolled over directly into your solo 401k plan as well. Solo 401k plan gives you virtually limitless investment options. Again, real estate, tax liens, mortgages, businesses, you name it. The list goes on and on. There is no such a list of allowable investments in your 401k. What the IRS does, they actually give you a list of things that you cannot do. So, and if the potential investment is not on that list, that means you can do it. And in just a couple of slides, we will go over those options and things that you cannot do with your retirement account. We'll cover that. So the question also often comes up, can I finance real estate purchase inside of my IRA or 401k? Yes, you can finance, but you cannot provide personal guarantee. That's why non-recourse loan must be used. And non-recourse means that if you buy a property in your own name and you go to the bank and you apply for a loan, the lender will look at your credit, at your income, how much money you have. They will look at your ability to make payments on that mortgage. And you personally sign for that loan. So basically, you're responsible for making payments. If you ever fall behind and lender have to foreclose on the property, and if there is still outstanding balance, they will come after you. But that's not allowable with the IRA or 401k. That's why it has to be non-recourse. And that simply means that the lender, the only recourse that lender has is the property itself. So you cannot provide personal guarantee, and lender cannot come out after you or after any other assets of the 401k. And because of that, there is more risk for the lender. And typically, you need 30 to 50% down, depending on the property that you're buying and depending on the lender that you're using. So you need about 30 to 50% down to acquire, but you can get them all day long. The property must cash flow positive. You must have enough reserves, typically 10% of the purchase price. And it will trigger unrelated debt finance income tax if you do it inside of an IRA, but not with the solo 401k. And there is not too many lenders who do these types of loans. There is only a handful of nationwide banks that we work with that do this kind of loans, but they have pretty decent programs. I personally purchased a property last year, and I put 40% down. Property is in Phoenix, and I got a 5/1 loan at 4.875%. So as you can see, very, very decent terms for these types of loan. So let's talk about what are the things that you cannot do with your retirement account. And there is only two types of investments that are not allowed with solo 401k plan. And that is collectible, is one of them. And that can be pretty much anything that is considered collectible. It can be stamps, coins, artwork, maybe even collectible car. So anything that is collectible, you cannot invest with your 401k. And then the S corporation is also not allowed because you have to be a physical person to invest, to be a member of the S corporation. And C corporation is fine. You can actually use your 401k to invest into the C corporation. And then on top of that, IRS says that there is a certain people that are not allowed to conduct any business with a retirement plan with your 401k. And that is described under Internal Revenue Code section 4975. And disqualified person is considered an account holder, so yourself, your spouse, and immediate family members. And that's basically your ancestors and linear descendants. So basically your parents, grandparents, your kids and grandkids and their spouses. And then also any entities in which disqualified person holds controlling equity or management interest. And we'll go over some examples in a few moments here, but some of the examples, exceptions of disqualified person can be a brother or sister or your cousin or uncle. So remember, it's actually very easy to remember if you just memorize my explanation here. So going sideways is okay. So linear descendants and ascendants, your parents and grandparents, kids and grandkids, and your spouse and yourself. But going sideways is okay. So your brother, cousin, nephew are fine. So what are the prohibited transactions? The same code defines them, and basically it is any sale, exchange, or leasing of the property between a plan and a disqualified person. Lending of money or extension of credit between a plan and disqualified person. That's why you need a non-recourse loan, because it's not allowed. Providing goods or services or facilities between a plan and disqualified person. And we'll take a look at some examples on the next slide. Transfer to or use by or for benefit of a disqualified person of the income or assets of the plan. And then act of disqualified person, who's a fiduciary, where he deals with the income or assets of the plan in his own interest or for his own account. So again, when you're dealing with a retirement plan, you're considered to be a fiduciary, and you have to deal it in the best interest of a retirement account, not your own. And then finally, receiving any consideration for your own personal account by any disqualified person who's fiduciary from any party dealing with the plan in connection with the transaction involving the income or assets of the plan. So and I know it might be a little bit confusing, so let's take a look at some examples here. So some of the common prohibited transactions include engaging in a transaction that is directly or indirectly with a disqualified person. And here's an example that people ask once in a while. So for example, somebody says, well, I do have a property that I own. Can I sell it into my retirement account? And the answer is no, because you're a disqualified person. We already talked about this. So people ask, well, can I sell it to a person who's not a disqualified? For example, my brother, he's not a disqualified person, and then I'll wait a bit, and then he sells it to my 401k. Well, guess what? If you're trying to do this just to basically avoid the prohibited transaction, then this is an indirect prohibited transaction and still prohibited. So you don't want to go that route because the penalties are very steep. Penalties actually for violation up to 100% of the balance of retirement account. Now next is a purchase of property from a disqualified person. Again, it's a no-no. Using 401k plan as a security for a loan, you're not allowed to do that. Guaranteeing a loan to your 401k, you're not allowed to provide personal guarantees, so that's why you have to get a non-recourse loan. And then doing any loans between a 401k plan and disqualified person. Here is an example of that. When let's say you have $50,000 in your 401k and you're looking to buy a property for $75,000. So you're short, but you have some cash in your personal account. And you say, well, can I lend it to my 401k some cash so it can buy the property? The answer is no. Now, if it was your brother or somebody else who's not a disqualified person, then they can lend. But remember the number one, you cannot lend it to your brother so that your brother lends it to you. So that will be indirect prohibited transaction. And then selling personal assets to the 401k plan, again, not allowed to do that. Investing in business in which plan participant or other disqualified person already has 50% or more ownership. Receiving any consideration for your own personal account in connection with the transaction involving the income or assets of the plan. This also comes up, especially with real estate agents. I have a number of clients who are agents, and they say, well, can I actually, I want to buy a property for my 401k. Can I act as an agent for that? Well, the answer is no. You better give that transaction to somebody else and let somebody else be the agent on that particular transaction, receive commissions on that. You're not allowed to do it. And then being compensated for any services and doing any work on the property itself. So if you're buying a rental property, you're not allowed to do any work on the property yourself. You have to hire somebody who's unrelated person and not a disqualified person. And then commingling funds between the plan and the personal account is not allowed. You have to keep it separated. So it's very easy to set that up, just a 4-step process. Number one, you decide that you adopt the plan, and then plan is established, and the trust is created, and trust is going to be the vehicle that will hold all of the assets of the plan. And then number 3, you fund it, and you can fund it by either transferring existing retirement accounts from your other accounts that you have, or just making a contribution. And because the plan allows you to make large contributions up to $50,000, it's very easy to just start one plan from scratch and fund it and then make an investment. And then finally, once the plan is funded, you as a trustee, you write the check and you make the investment. As simple as that. Buying real estate inside of your 401k is quite simple, but all of the income and gains generated by the investment must go back into the account on a tax-deferred basis. So you're not being taxed on any gains. You actually will pay taxes at a future rate, and you're able to take advantage of tax deferral. You can grow it without being taxed, which allows you to grow your assets much quicker. Now, if you do it inside of a Roth 401k, obviously it's going to be tax-free. And then all of the expenses on the property or any investment must come out from the plan itself as well. So that's very important. You cannot commingle. That concludes my presentation, but I'd like to offer everyone who attend a free consultation. You can actually go directly to my calendar, which is located at this URL, SenseFinancial.com / free consultation, and that takes you directly to my calendar. You can actually click on the day. You can specify which time zone you're in, regardless whether you're on the East Coast or West Coast. You specify where you're at, then the calendar adjusts, and it will show you the times that I'm available. And so I do it in 15-minute slots. You can just go there and you can book the time. Again, SenseFinancial.com / free consultation. And here's my contact information if you'd like to reach out to me. The office number is 949-228-9394, and my email is Dimitri@SenseFinancial.com. So again, thank you for joining us. Hopefully you learn some things that can benefit you and perhaps save you on taxes, and also as an alternative, put some real estate into your portfolio. Again, you just seen some great investment opportunities that can be a good fit for this.